in no particular order, Johnny Clark from WSP Environment and Energy, where he is, John is the Director for Environment and Energy, responsible for setting and implementing strategy to develop their sector growth across generation technologies as well as transmission and distribution infrastructure. Also joined by Rory O'Connor, a Managing Director at BlackRock, who are a global asset manager with some 3.5 trillion assets under management, and Rory is a member of their renewable power group. And finally, but by no means least, joined by Dr. Keith McLean, Policy and Research Director of Scottish and Southern Energy. Keith joined SSE in 1994, has been very active in the years since then. More recently, since 2004, responsible for policy and public affairs. He is also, in addition to his role at SSE, Director on the board of the Scottish Renewables Forum and also Chairman of the UK Business Council for Sustainable Energy. So an interesting panel and an interesting topic. So just to start off in a little bit around where are we now? The publication that came out last week with the revised bill and associated documentation, of which there has been a lot, but something that we've been waiting for as an industry for a good 6 months, since May, if not earlier. Now that the bill's actually been released, what sort of responses have you seen around the energy industry? And I should perhaps add, for the benefit of the listeners, that all of us who are talking here today are not particularly representing the views of our respective organisations. We, because of our organisations, obviously have an informed view from particular perspectives, but the views we're expressing today are personal, drawing on our experience both from our own organisations and our contacts in the wider industry. So this is very much personal industry views rather than organisational views. So perhaps to kick things off, Keith.
Well, we're still ploughing through the documentation, and I think that it's important to note that this was 1,000-page of an update on top of everything that has come before, and I think it shows just how complicated everything has become, and that's, I think, an issue in itself. However, in a number of areas it does give greater clarity than we had before. There have been a number of areas where the government has listened to the issues that were raised around the draft proposals, and particularly they've moved on the counterparty issue. But I think that one highlights that although they've moved in principle, there's still so much detail that we need to understand before we can really fully understand the impact on that. And a lot of the detail isn't ever going to be in this bill. It's going to be in the secondary legislation and the regulation and license modifications et al. That we need to wait even longer for. So we're definitely embarked on a longish journey to get where we need to be. I think in general it's always positive when you're not surprised by announcements. So the fact that the announcements last week didn't seem to contain any surprises was good. And one thing that investors absolutely hate is hearing mixed messages. And so we're very hopeful now that the new accord that seems to have broken out across the government will mark the end of a very mixed message chapter and start and be the beginning now of a joined-up message. There's one thing that is absolutely clear. Not only do we need this government to be joined up in what it's putting forward, but really for a lot of the long-term investment we need to have cross-party support for what's going on, and this is why it will be very interesting to see how the bill committees and how the debates in the House pan out, so that we're not getting to the end of this Parliament and finally all of the energy bill being implemented, only to find that we're back into a new energy bill with the next government.
Yeah, one of the concerns that I have around this joined-up approach, which least personally, I haven't had a chance to read any of the detail. I believe it was published about 10-15 minutes ago, is the gas strategy and how that ties in with the package that's just been published last week. The gas strategy, wherever it's been published in terms of the sort of lead department on the publication, does appear to have a strong influence of Treasury. So I do have a concern that the truce, to call it that has been knocked together might hide some sort of structural difficulties in the overall package that's been put together. I don't know sort of whether perhaps the investment in community, Rory, has sort of got any thoughts around that particular aspect, and indeed sort of the wider sort of initial views on the overall package.
Yeah, I mean, I should prefer to take it back to the wider view. Obviously, EMR has been in discussion, being talked about for a long period of time. You know, it's recognised by industry and particularly by governments and DEC that institutional capital has a significant role to play along with other industry participants in the changing energy mix of the UK. And a lot of the themes that are important on the institutional side have been listened to quite carefully. So we see that as a positive. I think to echo a lot of Keith's comments, the bill is a good starting point. As you say, there's been no negative surprises within the bill. The counterparty issue, it certainly looks like that issue is being listened to and addressed. And so, my perspective, which is one coming from the institutional capital side, and also actually, focused on renewable investments in institutional capital, we'd see the bill as as a positive overall step forward. There's an awful lot of detail to come over the course of the next year, and as often is the case, the devil is in the detail. But it's been a good sort of staging post to get to this overall point. And again, just to echo, coming to the second part of your question and echoing Keith's comments, the key, one of the key areas of focus from institutional capital is that we have long-term policy stability. Institutional capital is providing an awful lot of capital for long-term returns, and I think the key from the industry's perspective and government's perspective is to both have that capital flow and also have it flow at the right cost of capital. And it's difficult to sort of overemphasize, but the long-term policy stability and recognition of that is, and the perception of that from investors is very important. I think heretofore, the government has always been very cognizant of that. It's put a lot of thought into, they had a ROC regime, will go into the CFD regime. Is very, and the government and DEC have been very, I guess, very articulate and very vocal about that understanding that importance. But it needs to be, clearly, that needs to be delivered on over a long period of time, because these are 20, 25, 30-year investments that ultimately, pension funds and insurers are making in the market for, and that long-term policy stability is very important.
Yeah, no, totally. One sort of thought on that before turn to Johnny. From sort of the bits that I've read around sort of looking forward program, we've got lots of consultations, calls for evidence, various proposals coming out between now and effectively the back end of next year, which my impression is that the government seems to think that this process is giving enough stability for people to start making investment decisions sooner rather than later. Personally, I'm sceptical of that until we've actually got that layer of second legislation not just drafted but actually on the books, so people can then see exactly what this means in practice. I can see Keith shaking his head vigorously next to me. Rory, do you sort of share those views generally, or?
I think we are, for good reason, at a transition point as we move through EMR. And that across the energy mix that creates different decision points for of the primary builders of the assets. So I think a lot of care and attention will be paid on decisions, particularly for the larger projects, over the next 12 months. But I think, perhaps Keith is probably better positioned to comment on that than I.
I think the problems at the moment are slightly hidden by the fact that there's been a mini boom in people trying to get projects away while the RO is still in place, and we'll probably come back later on to that. But there's a real cliff edge in 2017, which actually means decisions on investment in 2013-14, because that's the build period that you need in order to have a project that would be ready to generate to get ROCs in 2017. And we have the second cliff edge in 2020 with the targets coming to an end, and no clear idea of what's happening beyond that. And I think, Simon, you're absolutely right that we now have a whole series of known unknowns that have been created by the EMR process, which mean that people quite rightly want to have that information to present to their investment committees before they can take them forward. So we got some interesting statistics from Bloomberg New Energy Finance, which shows after the publication of the EMR and so on that in renewable investment decisions made has absolutely plummeted from a really quite nice peak that we got to in 2009, and despite the mini boom that we've got at the moment of people trying to take projects forward, there's been pretty much a collapse in new investment decisions around renewables. And if you looked at the graph for gas, it would be very similar for slightly different reasons. But to get investment going again, people will need to understand what the market looks like, what the legal and other regulatory structures look like. And I think it's a very brave investor that goes ahead thinking that they know what the outcome is going to be when there are so many details of a very, very complicated jigsaw picture that need to be put in place. And at the moment, we barely have an outline of the corner pieces.
Johnny, you've been sitting there very quietly. Your thoughts, first of all, just around sort of these general questions about where we are with the bill and sort of the investment decision impacts that you think they're going to have.
Okay, thanks. Good afternoon, everybody. Yes, I guess starting off with my optimist hat on, obviously the the overarching objectives of the bill are laudable. I think there will be, and indeed speaking to our developer clients, there is obviously interest and excitement about the potential increasing the volume of renewables within our energy mix from about 11% to to more like 30% by 2020, and particularly amongst the wind developer community we work with, the number of gigawatts that needs to be generating, being bounced around is in the order of 30. So on the basis we've currently got about 5 gig onshore and a couple of gig offshore, you can see there's a huge potential there. So that's those are all the positive messages. But of course, and very much echoing what the guys are saying, when you then get down to the nitty-gritty, the response is a bit more mixed, and clearly there's an awful lot of detail that still needs to be bottomed out before you can put together a commercial model, a viable commercial model. There's no indication of what the strike prices are likely to be, and clearly that's absolutely critical to getting projects away. It was interesting what Keith said at the start as well, because again, a lot of people I've been speaking to are not that convinced that the political risk has been completely allayed. There's still a view out there, I think, that there's a lack of coherence in how the government is approaching this. So, for a whole raft of reasons, I think the scepticism and again, to use the word devil in the detail, is entirely appropriate, and I think there's an awful lot that still needs to be done before before people are able to go away and dust off their commercial models and look at them and say, yeah, that's going to work for us.
In terms of assuming the detail gets filled in for a moment, which that is quite a big assumption, let's just make it. We've got the EMR package on one side, we've got the gas strategy on the other. Johnny, do you think you're going to see sort of a combination from these things to sort of particularly shake up the energy mix from where it is now? Yes, new old plant coming online, offline, but in terms of the overall balance? Or do you think that sort of policy is going to see quite a dramatic change in energy mix over the next 25, 30 years?
I think there's no doubt that there will be a change in the energy mix, and indeed there has to be, with our reduced reliance on coal-fired power stations. Exactly what that mix is going to be is obviously dependent upon how effectively these measures are implemented, but clearly, based on the government's aspirations, we would expect to see an expansion in gas, and I include within that unconventional gas. You know, they've clearly sent the message out to the market that they expect there to be more development in that area, and similarly we would expect to see an increase in the proportion of renewables based on the aspirations expressed in the bill. So I think we'll definitely see a change. It's how quickly they can move to give the investment community the reassurances they need to actually get the projects moving forward and get them built and get them operating.
Yeah, no, anything to add on that, or should we move on to...
Just perhaps one sort of point to make from the perspective of institutional capital. So institutional capital typically will invest in projects once projects are operational, or occasionally will invest from the start of construction onwards, and if you like, allow capital recycling from developers and utilities at that point. The decision-making process for the ultimate builders and creators of the projects, utilities and developers, happens earlier in that process. So while institutional capital will sit into a project in the full knowledge of what what regime and what support that project has, that decision making can happen a number of years beforehand, and I think that's that level of uncertainty that exists on the project side is, I think that's probably a bit of the headache that's created by these changes. On the one hand, it's not necessarily a risk for institutional capital, but nonetheless, what institutional capital and what everyone needs is a good flow of projects through the mix. So just to make that distinction, and I think in terms of how the energy mix will change, I think to echo Johnny's point, I mean, we do see renewables growing, as a significant portion of that energy mix. I think that will be an outcome of this whole process. And as with everything, the question is time and how quickly.
I want to move on in a moment to the contracts for differences, which is one of the key, if not sort of the most significant intervention into the marketplace. But before I do that, just a couple of words on the capacity mechanism which is being planned, because this has been portrayed as one way to deal with perhaps some of the gas requirements and the insurance policy against the lights going out. Now, again, from my reading through the documentation, what we've been given so far is minded to positions with basically we need to go away and do much more thinking and work around it. And therefore, to my mind, it's quite difficult to understand quite what this market's going to be, therefore what drivers it's going to give an opportunity for investment until all that detail gets knocked away. Just very briefly, perhaps just the three of you, whether you agree, disagree with that at this point.
Yeah, I think the changes that we're trying to achieve in moving to a much higher percentage of renewables for energy production have created an issue that we didn't used to have when we used to invest in coal, in gas, in oil, and to a certain extent in nuclear. We got energy production, we also got capacity, and usually we got flexibility and services that were needed in order to provide stability. Now, we're now moving towards technologies which do not have all of those, and we need to have a market which separately values energy production, capacity and the security of supply that brings, flexibility and the services that are required to make it all work. And I think it's a perfectly reasonable debate then to have about how to encourage capacity, for plant which will generally run much, much less than it did before, and even run at lower prices because it will be competing with zero marginal cost plant, and therefore the capacity market providing a longer-term fixed payment for the capacity is actually, I think, more in consumers' interest, having to justify extremely high short-duration spikes, which doesn't seem to be a very good way of getting a low cost of capital attached to the investment in that capacity. So we think that the capacity market that is being proposed is a sensible one. We agreed with the outlook on capacity that Ofgem came up with, and that suggested the timing was sooner rather than later. We see that DEC has now come up with its own decisions around that. Let's hope they're right. Certainly the mechanism we think is a good idea. But I would slightly disagree with you, Simon, in terms of intervention in the market. If you listen to the European Commission on this one, they actually see the capacity market or the developments right across Europe around capacity as the bigger threat and the bigger issue for them. I think that we have but it is a natural consequence of the direction that we're going in, and it is something that needs to be done to manage the risks that we have. And the proposals generally seem to be quite sensible, if a bit late.
Okay. I think I'd like to just sort of move on at that point, if I may. Apologies, Johnny, or if you want to add things further, but I'm conscious of time. Contracts for difference. The most significant, second most significant intervention into the market, either way, it is a dramatic change from how capacity has been added to the system over the last 20 years. Do we agree with the proposition that the promise of stabilised revenues for generators will lead to increased investor confidence and therefore build?
I can come from the perspective of on the institutional capital side, with the view of, again, increasing the flow of institutional capital and having that at a reasonable and appropriate cost, and looking at it from investments at an asset-by-asset level. There is the reasonable argument to be made that by taking effectively merchant risk off the table for the first 15 years of an asset life, that you're reducing the overall level of risk in the mix. And you've seen the success, speaking narrowly just about investments on an asset-by-asset level, we've seen the success of investments in other FIT regimes such as Germany and France, which have a relatively low cost of capital in the mix. So on the short answer is this is a positive thing from the institutional capitalist perspective. CFDs are relatively complex. I think some of what we've seen in the energy bill is looking to kind of reduce that complexity and provide visibility on the ultimate counterparty, and that's helpful in the overall mix. Capital is global and can flow in many different ways, but overall we see this as a positive move. Inflation linkages is very important and can be quite attractive from the perspective of institutional capital. So maintaining that is I think important as well. Obviously, with power price linkages, you do get some indirect linkages to inflation, but CFDs with inflation linkages should overall be attractive from the perspective of long-term institutional capital.
Do you think that's going to be reflected in the lower cost of capital, which is one of the things that the government are asserting will happen with this CFD approach?
Yeah, I think so. With the right, the cost of capital, it ultimately is a reflection of everything. The features of the actual project itself. So taking merchant risk off the table is helpful from a cost of capital perspective. If the structures, the counterparty structures are set up and are clear, that's also very helpful. And if the overall picture of the government and the country's long-term commitment to supporting those projects is also clear, and it's perceived as being clear, which I think will certainly be the case, then overall we should have a reduction in the cost of capital, and also an increased flow in the cost of capital. The most, there is, if you look at our European peers, there's quite a lot of institutional capital flowing into these assets, but ultimately the correct source of a large amount of this institutional capital should come from UK pension funds and UK insurance institutions. And I think ultimately we'll get there with the long-term CFDs, maintaining inflation linkages, and, if you like, long-term clarity and confidence in the overall policy support mechanism.
The sort of move to CFD from a regime that's relatively well known and understood with the renewables obligation must present sort of a number of challenges and opportunities. Johnny, are you sort of seeing particular elements from your sort of viewpoint?
Yeah, I think just picking up on a couple of points there, that clearly the purpose of the CFDs in terms of assuring affordability and providing more long-term stable returns, as I said at the start, laudable, and I don't think everybody's bought into, but clearly and I referenced strike prices as still being an area of uncertainty. I think there's also still some questions to be answered around how the CFD counterparty will operate, and I think particularly you've got questions around the potential for incentivizing the construction of new assets versus simply rewarding existing generating assets, and I suppose it's possibly one for Keith. Will be interested to see what his view is on it from a supplier's perspective. But I guess there is potential. You could almost sort of cynically say that, a bit like the banks holding on to the cash after being refinanced, how are the suppliers going to operate under CFD in terms of existing generation versus constructing new assets?
Yeah, a couple of comments. I think that Rory's made the point a couple of times that the institutional capital will be looking at the operational assets and how attractive it is to refinance an operating asset and bringing that capital in is one question or one challenge. The other one is how you get it built in the first place and who's actually going to do that, and how attractive is the CFD for the utility sponsor in all of this. And that's a bit of a moot point for some, because we actually quite like managing market risk. It's part of something that we do well. We think we can have a competitive advantage out of, and that we think that we do well on behalf of consumers and help keep their costs down by managing the risk well. So if you take away our upside from that, it makes it much less attractive to take construction risk and all these other things only to produce an asset that might be moved on. The other point is that what we have to remember is that we're not taking the risk away. Well, this isn't a magical formula to remove market risk. So what we're doing is transferring it somewhere else. And if we're transferring it, then we should be transferring it to somebody who can manage it better, or at least not worse than who's managing it at the moment. Otherwise, the overall cost of managing that risk will increase, and therefore the overall costs to consumers will go up. And this is our concern at the moment, that even with single counterparty, ultimately it is transferring risk to the consumer, and the proxy for that is the supplier, who is not well placed to manage the risk, doesn't have the assets to back a lot of it, and therefore it may well increase the costs for consumers by increased costs for supply rather than for generation. We don't feel that that's been properly evaluated, and it is the call, one of the many calls for evidence that we now have on that. So there's a similar example for that we had with the OFTO regime, which gets a very low cost of capital that applies to the transmission assets, but unfortunately it piles much more risk onto the generation assets, which are more valuable. So a slight increase in the cost of capital in generation has a disproportionate impact on the overall costs. So we just need to remember that none of this is removing the risk. And what we also see in a number of the European countries who have used low-risk fixed feed-in tariffs, for instance, then that is now creating such perverse market behavior because there's no price signal or dampened price signals for the operators that they are now trying to move to a premium feed-in tariff or something which keeps that price signal there and keeps all of the investment and operational decisions that are being made sensible rather than perverse, which is where they are at the moment. Just one final point. You mentioned sort of the legal framework and things that we need to go through there to make all of this work. And I think we mustn't underestimate state aid and getting state aid clearance on these issues, not least for nuclear, where we're talking about a 60-year-old mature technology, and where we certainly think that there are a number of legal challenges that could potentially slow down or even block some of the proposals.
No, state aid is undoubtedly one of the key open elements, I suppose, in terms of implementation, because until the state aid clearances come through, or if there can be a strong enough body of opinion for people to get comfortable that there isn't a state aid issue, which is an alternative the government are investigating. Again, that's sort of a major open that's out there. One of the other sort of legal problems which the previous proposals had was the lack of clarity around the framework for the money flows, to call it that, which the government have put forward this central counterpart body to address that. And we have then behind this cascade of obligations to meet perceived funding gaps. So we've got, if the employer is solvent and they're not paying, then there's a financial penalty of up to 10% of turnover. If and then on top of that, they've got specific CFD collateral requirements. On top of that, unsecured losses can then be mutualised. On top of that, there's a backstop potentially of either a new CFD counterparty if the body in the middle is at fault, or you've got the supply of last resort if it's the supplier that's causing problems. Yes, there's lots of detail to fill all the pieces, but in terms of an overall sort of architecture and mechanism, to me, that seems to have a degree of legal robustness, and I can quite easily see how it could be implemented to work. But is that something that's giving sort of other parts of the industry who perhaps don't have the legal background the level of comfort that the government seems to be putting towards it?
If I can sort of chip in with one sort of area of legal concern, or at least compared with the existing regime, and that is if you move forward with a ROC, then you're unlikely not to be accredited. But from what we can see with CFD, there's an allocation process, and there are stages in that process, but it doesn't necessarily guarantee you an agreed price at the outset, or indeed an allocation. And I don't know if that's something that that others on the call have picked up, but that's definitely something that we think needs to be addressed, because at the moment it's an allocation on a project by project basis rather than a broader mechanism, and that obviously relates particularly to the recycle price element of the ROC, which doesn't appear to exist with CFD.
I absolutely agree that allocation is a big issue, and it becomes a bigger and bigger issue the larger the project is, because your development costs that you're putting at stake before you secure a contract are much higher. There has been some movement on that, but I think one of the inherent problems that the CFD has that the ROC or the feed-in tariff doesn't have is the volatility, the very volatility that it creates. And putting that into the corset of a levy control framework makes it very difficult to predict how much of a levy there is going to be. So if you need to know how much, what volume of what technology at what strike price is operating at any particular period over the time to understand how much money is going to be taken out of the pot and therefore be available for new contracts. And because you've got the potential for the flows to even flip, if you have generators all paying in, then you're building up a fund. But if it goes the other way, then you'll use up the fund much more quickly, and that makes it much more difficult to predict than the RO is or a premium feed-in tariff would be, as to how quickly the fund's going to be used up, and is there going to be money at the end of my development process in order to secure me a contract. So I think there has to be clarity on route to market, and I know that for a lot of the independent developers, that uncertainty combined with the uncertainty about PPAs and or whether they need one, whether they'll get one, and so on, it makes it quite a difficult ask for them, and it's a very difficult ask for them because they're generally dependent on getting third-party finance from the banks, who all those that we're talking to at the moment are saying, well, we want to see how this works before we're going to put any of our money down this route. And so you're talking 2016, 17 before some of the banks are going to even start getting comfortable with it.
And one of the other sort of legal risks that I think could be exacerbated by the CFD approach is the whole construction risk element, where the CFDs are putting in place a commissioning window, a target. And if you're outside of that, okay, your length of CFD income then reduces, but also there's a long stop date which kicks you out the process completely. You've got to reapply. Now, an onshore wind farm has a degree of risk to it. A close offshore wind farm has a different one. Some of the deep sea zone 3 stuff has got a completely different risk profile. So there's another layer of construction risk. I think this process adds in to what is already a challenging build approach to manage.
I think the other risk which is being added into this is many in the industry, in fact it's probably been one area that the industry's almost been unanimous on, is that auctioning is not an appropriate process to deal with the challenges that we have in these investments. So to actually be introducing auctioning from 2017 adds a further risk that if you're not in a position to be able to secure something before then, you might get stuck with auctioning. And I think that debate really needs to be had quite seriously with government, that that is not the way you're going to get offshore wind built if people think that they're going to be competing in an auction.
Do you think the auctioning will make a difference to the availability of the finance, or simply that's just going to be a prohibitor to projects coming forward?
A big offshore wind farm, you're going to be putting tens, if not hundreds of millions of pounds into developing that, securing your grid, getting your planning, or over a number of years. It really does seem crazy that you would then do all of that. If an auction process is to be successful, there has to be more than a zero bidding is not good. One bidder isn't a good place to be, so there has to be multiple bidders. So to be successful, it means you're going to have disappointed bidders. And a disappointed bidder with a large offshore wind farm will have spent tens or hundreds of millions of pounds. Now, I don't think many people will take a punt on that. You might do it with planning permission on onshore wind farms, where you would say, right, I've got an attrition rate maybe of 50%, but I know I'll have another opportunity, and we'll get something coming through. But these things are far too binary, and you're just not going to be able to have a good overall batting average. So it just seems crazy to even contemplate it.
Well, I think particularly even for onshore, where you're talking about, there's a broad range of developers out in the market there, and potentially going down that route, you're going to exclude fairly significant parts of the existing market. They're just not going to take that risk.
And I think that's a really good point, because the things I was talking about earlier on for suppliers and these issues for generators are putting massive new barriers to entry for smaller independent generators and suppliers, which is completely contrary to the high-level principles of what EMR was designed to encourage. And you're really making it such that only really big players with very, very deep pockets have any chance of coping with it.
Sorry, John, you wanted to say something?
Well, I was just going to reiterate that point, going back to the PPA argument that that Keith was making earlier. That's exactly it's the same issue where you've got small developers. They still need to get a PPA to get the finance. There's potential for that PPA market stagnating, and the government, would then have to look to intervene. But you can't expect, or one wouldn't expect, the government to then force a supplier to take on something that they're not willing to take on. So it's there's obviously quite a lot of work that still needs to be done to kind of address these issues.
Yeah, I think definitely the sort of route to market is a concern, certainly on the developer side. One point just to come back to to pick up on the themes Keith was talking about on the offshore side. Offshore is clearly a critical component of the country's energy mix. It's a key area of focus of the government, and considerations around it drives a lot of what we're currently talking about. The key developers of those projects in the UK market, bar one or two quality exceptions, are the utilities, and they I think actually the country is fortunate to have that. A number of very large, sophisticated, reasonably strong balance sheet developers that can deliver these projects. Unquestionably, there's a huge amount of institutional capital that needs to come into those projects to make them work, just given the scale of capital required, and work in partnership with the utilities. But that capital will come in at that later stage. So, to the extent utilities at an earlier stage are delaying decisions, are having difficulties progressing these projects, that is a real concern, and it does require a lot of thought. Just the scale and the timelines of these projects are very significant. So I just want to echo a number of the themes that Keith has mentioned there, because I think this is where institutional capital is required, but it needs those strong projects to invest into it as well.
And from what you were saying earlier, Rory, and do correct me if this is wrong, but you were saying earlier that you weren't particularly looking to take construction risk. You wanted the operating plant out there to then sort of have the stability for the investments that the institutional investors generally will be looking for. And so therefore, this auction process, if it came in, would be yet another hurdle actually getting the plant up and operating. So again, it would just be yet another reason not to be stepping in earlier in a project's life cycle.
I think in relation to onshore wind, construction risk is a lot more understood. The timelines are shorter. In respect of offshore wind, maybe over time we'll mature into the situation, but certainly, it will be a lot easier for institutional capital to come into operating projects when we're through the construction cycle and we've got, and the period of time of operating data, and also to deliver capital at the right cost of capital for those projects. I think that's very important as well. So to do that on a sustainable basis, it does, really require those projects to be up and running and built for that appropriately costed flow of capital in the mix.
So that then leaves the challenge for, quote, the developers to actually self-fund, in a sense, what, as Keith said, could be some quite substantial upfront costs to get to the point where they can recycle through a refinance, which could be challenging. We've already mentioned.
Just perhaps, I mean, we may get to a stage whereby, people become more comfortable on the institutional capital side with investing earlier into projects and closer to the COD stage, closer to construction. But that's a good bit away. So I think your point still holds quite firmly.
I think moving on, we sort of touched on some finance themes on and off up until now across this. So and one of the areas that has generated a lot of heat in the press, if nothing else, has been the inclusion or the lack of inclusion of a specific decarbonisation target linked to 2030. We've seen with the draft proposals now a reservation of powers to bring a potential target in for the fourth carbon budget for 2016, I think, onwards. Do you think that the lack of that sort of target is going to have a major impact on investment in this world where we are at the moment for new plants?
Yeah, I think I mentioned earlier on the two cliff edges that we've got. I think the answer is fairly simple. If we want to develop a supply chain and get the economic and employment benefit of all of these billions of pounds worth of investment, if we want to see the supply chain investing in R&D to bring the costs down, if we want to see them investing in the standardization of production in order to bring the costs down to make the energy more affordable, we have to give the supply chain the clarity of vision and a clear narrative about how we're going to achieve that for them to invest. And at the moment we don't have that, and so considering that out to 2030 is just the next investment cycle for pretty much all of the manufacturers, it's absolutely essential that they are able to see beyond the cliff edges. So we think that two things are absolutely essential. One is that until we get the CFD sorted out, we don't block access to the RO. We need to keep the RO open until everything, we're happy to agree what the criteria are for successful implementation of the CFD. So that takes away the 2017 cliff edge. And we should be thinking, as indeed the European Commission is very sensibly, about what we do post-2020 to get the clarity there. And it's a clarity that we need for gas investment as well as for renewable investment. It's not a specific greenie
and nuclear as well.
And nuclear.
Yeah.
It's a sensible thing to be looking ahead at your long-term infrastructure and what the vision for getting that and the route map for that is. So we need to have a clear and binding framework that gives us that, and then we can get the supply chain benefits, we can get the job benefits, and we can get the affordability benefits that brings.
Johnny, have you been picking up much in the way of concerns or indeed positive comments from the supply chain around all this? Because as Keith says, it's vital and it hasn't got too much coverage from the government side, but without the supply chain being in place, none of this can happen.
No, that's absolutely right, and I think the general consensus has been that they would have expected, we all would have expected stronger signals around decarbonisation targets. I mean, it's always difficult to know exactly what the counterfactual position would have been under alternative scenarios, but I think there's no reason really why the bill couldn't have included a bit more detail on on overall targets and progress towards those targets. I mean, the reality is that, frankly, we're sat here talking about this now. We should have been sat here 10 years ago or more talking about this, and those signals, we shouldn't be just looking for those signals to come out once every blue moon because we're heading towards a crisis. You know, this is something that's been kind of neglected for a long, long time, and that's very much how the supply chain feels about it. We all feel about it. It does mean that there's going to need to be one heck of a lot of activity across all of the segments of the market that we've been talking about on this discussion. You know, unfortunately, it's going to be very difficult for the supply chain to accommodate all of that activity in what is effectively a relatively short timescale. And you know, Keith was talking at length about offshore wind. There are huge shortages of capability and experience in that market, and you know, it's something that really it should have been envisaged much earlier, something done about it much earlier, and an investment gone into it much earlier, and it would have made the development process and indeed the consenting process a lot smoother.
Just following up on that sort of with a consequential thought, assuming again that we get some sort of go-ahead in terms of the projects, it's not just the projects that are going to need the investment. As we've heard, the supply chain are going to need to sort of, in a sense, ramp up a level to meet the substantial number of gigawatts that we need built over the next 10, 15 years. Is there money for that layer of investment on top of the top layer of investment, so actually the supply chain can step up in the current sort of economic climate with constrained lending?
I think the point is made by a lot of the banks at the moment. It's not the shortage of capital that means money's not flowing into this market. It's the political risk that's been created, which makes it unattractive to put that money in. There's a real appetite for an awful lot of private capital to go into this market, and if it starts flowing through, then that's the beauty of it. It goes through into the supplier, and it's not just the turbine manufacturers, it's all of the supply chain that deals with it, right down to steel. Steel is already seeing the impact of the hiatus in energy investment, and so we need to get that going again, which is why we need to take away the uncertainties that there are at the moment, remove those cliff edges with the two things I said. And you know, one of the things that is so indicative of the problem we're in is that not one of the turbine manufacturers has received an unconditional order for a single turbine from the whole of this year, single offshore wind turbine in the whole of this year. That's the hiatus.
It's also indicative of the chart. Perhaps if it's possible, that chart could be put up on the screen when this is circulated, because it is an interesting, obviously subject to copyright from the.
As long as you mention Bloomberg New Energy Finance, they're happy to be used.
I think while you're doing that, I mean, one other point about the supply chain is that supply chain can go pretty much anywhere in the world. Very much, a lot of it can anyway, and if the investment is flowing elsewhere because the barriers are somewhat reduced, or it's easier to do business elsewhere, there's more certainty around pipeline of projects and opportunities, then that's where the supply chain will go, rather than the UK, and that's another point to just kind of flag up, I guess.
There's an interesting, just from the perspective of institutional capital, we'll also look at this quite closely, and obviously the ideal situation is a virtuous circle whereby you have a lot of supply chain sort of embedded in the industrial base of the UK, and that in turn has a sort of positive reinforcement effect on long-term policy. And you know, from the perspective of institutional capital, again, it's an important additional level of comfort that one takes in the importance of this sort of indigenous industry, and particularly in respect of offshore. I mean, the prize there is very clear, but it's we need to get to that virtuous circle whereby it's an important piece of the energy mix, of the industrial mix, the policy mix, and then much easier from an institutional capital perspective to provide the long-term money that's required.
Just taking a step back again out of some of the detail, sort of two themes just want to explore a little bit by way of just putting it all together as the wrap up. the market reforms are being driven not just by decarbonisation, it's part of this balance of security of supply, climate change, as well as sort of older generation plants. One of the sort of assumptions that, at least to me, seems to be underpinning some of the analysis is that gas prices are only going one way, and that is up. Now, we've seen that reverse quite dramatically in the US with shale gas. We've seen from the Chancellor's announcement stroke, the gas strategy coming out, a lot of support for potential shale gas in the UK. Do you agree with that view that this is underpinned by gas prices going up? And if you do, what do we think the effect could be if actually gas prices reverse? Keith?
Well, we're getting into crystal ball territory where my one's not very good. But I think you're right that there is an awful lot predicated on a single view of where the energy prices are going to go. And I think that's a very dangerous way of deciding on such big measures and issues such as this. And I think if you're right that there's been a massive change around with the gas price in the States because of what's happened, and you mustn't forget that there have already been consequences of that over here. That very cheap coal, which the Americans don't need anymore, has come across here and meant that we've been burning an awful lot more coal than we would otherwise have done at a lower because of the lower cost. I think that it is too dangerous to pin the policy only on being successful if we see a continuing rise in gas prices, and indeed, how will gas be price setting for electricity for forever? What other things might be happening there? So I think we need to look at possibly slightly more resilient analysis as the basis for decision making, and not sort of hoping or pretending that that will be the single outcome, and therefore we build all of this around that.
Johnny, have you got anything to add around that point, or shall we move on?
I guess only that what the bill does set out is aspirations for a robust, or it aspires to a robust energy mix going forward, and I think sort of echo what Keith was saying. It's probably a bit dangerous to to say, well, what would things look like with eggs in one basket if we were if we were more reliant on gas and so forth. And I think the other point to make is that we all probably sit there and look at it from an industry perspective, but we also sit there from a consumer's perspective every month or every quarter when our electricity and gas bills come in, and I think it's an oversimplification to just expect that unconventional gas within the UK would be some kind of panacea either to our broader energy requirements or to the what we see in terms of gas and electricity price inflation. So I think those are probably the only points that I would make. But like Keith, be unwilling and probably very unwise to crystal ball gaze too much.
Indeed, I think what I am willing to crystal ball gaze on is that there's still a lot to discover, a lot to work through, a lot to be done between now and the package being implemented and people being comfortable to invest. We've touched on a few of the many issues on this afternoon, and I'd like to take this opportunity to thank Johnny, Rory and Keith for their views and their thoughts, and also thank you to the audience for their logging on and listening, and I know they've been sending questions in, so thank you for that as well.
Cool, and thank you, Simon, for chairing, and I think the webinar's finished. Yeah.